Hey guys, mortgage deferral has been announced by the government and by the banks for over a month now. But I still hear a lot of misinformation, miscommunications on different forums or different groups. People have a lot of myths behind mortgage deferral. And today I want to break down those myths into 5 biggest categories. And after speaking with different lenders, banks, I've come up with the truth behind them. And I'm going to show you how mortgage deferral works. So I hope by the end of the video, you'll have a better understanding of if this is a tool that can help you during this COVID-19 crisis, or if it's something that doesn't apply to you at all. So let's get to the video. Now, the first myth that we're going to talk about is that a lot of people say mortgage deferral only applies to principal residences. And that is simply not true. See, mortgage deferral also applies to rental properties. Let's say if you're a landlord, you own a few rental properties, you may still be able to apply for mortgage deferral. The reason being is the government realizes that your tenant may have trouble paying you. And so you're not excluded. You are also eligible to apply for mortgage deferral. So talk to your bank and definitely if you need that, find out if you can get the mortgage deferred. Now, the second myth that a lot of people have is that mortgage deferral is expensive. Very costly, and that is simply not true. If you use it correctly, it is probably the cheapest way you can borrow money during this time to sort of pay off either the mortgage or pay for everyday expenses. So I'm going to show you a simple calculation. We're going to use simple math just to debunk why I've read that, different publications or different people have said that mortgage deferral is going to cost you $20,000, $30,000, $40,000. No, it does not. Again, it depends on the size of your mortgage. But for most people, we can use this scenario because it applies to them. So let's say your mortgage payment is about $2,000 a month. Okay. Let's say that you are asking for the bank to defer your mortgage for up to 6 months, which is right now the maximum the lenders will allow. And let's suppose that your interest rate is 3%. So your total amount of mortgage being deferred is $12,000, and our interest rate is 3%. And let's just say that you have 20 years left on your amortization. So we're going to go through a simple math. Let me show you the amount of interest over the life of the mortgage, the extra interest that you're going to accumulate. The reason we're going to use simple math, not compounding, is if we do compounding, yes, your interest will be more, but every month the amount of interest applied to your mortgage is less. The amount of money applied to the principal will be more. So it gets a little bit complicated. You're actually paying less and less interest, more and more towards the principal. So if we ignore that for a second, we just use simple math. $12,000 at 3% per year equals $360 per year. That is the amount of interest you're going to be paying on that $12,000 that you've deferred for the first year. And let's just say that over the life of your mortgage, you never caught up. You just let it blend in with the rest of the payment. You would have paid around $7,200. we'll keep this simple, and this shows you that no, it doesn't cost you $20,000, $30,000, $40,000. If we use a compound calculator to determine how, let's just say that most interest in Ontario is compounded semi-annually at 3%. Your total interest, it's about $9,700. That is taking into consideration that you never caught up. You just let it slide. So as you can see, no, it does not cost that much to use it. It's simply about $360 per year if you're deferring about $12,000. Now, how do we reduce the amount of interest you pay? Well, we can utilize a few tools that's probably part of your mortgage to help you pay off faster once you're back on your feet, once you're able to get back into work. First tool is mortgage prepayment. Mortgage prepayment is something that allows you to increase your payment every month or every payment period. So let's say you're on a bi-weekly, you're a monthly, you can increase that amount. Some mortgage will allow you to do that. Some will allow you to do balloon payment. So they may have a cap of how much you can pay off extra over the year, but during that year, let's say 3 months later, 4 months later, you're back to work, you're able to save up more money. You can do balloon payment every 3 months, 4 months to try to catch up. During that time, you're still paying your normal payments as per your periods, whether it's bi-weekly, weekly, or monthly, but you can do balloon payments. Or you can make a lump sum payment at the end of your term, at the end of the current year. Let's just say that you get some bonuses. You came across extra money after going back to work. You can use that to make lump sum payments. And the last point is, you should only defer as much as you think you need. Suppose that you are still working right now, you don't need the mortgage deferral right now, but you think it may, you might be losing your job or your hours going to be cut. You can apply then and just defer 3 or 4 months instead of 6 months. A lot of banks are still offering this program until end of June. So you still have time. If you haven't applied yet, you still have time to apply for it, and don't overdo it. That way you're going to be able to save yourself some money, but at the same time be able to get through this crisis a little bit better. So that's the second myth. Now the third myth is that a lot of people say that mortgage deferral is going to affect your credit rating. And that is simply not true. It shouldn't. However, there are a lot of human elements in terms of executing this deferral, from the application to changing the bank system. There are a lot of human elements involved, and what happened is that there may be possibility that something doesn't get input correctly, and the bank system speaks directly, automatically to the credit agencies, and they recognize that if you didn't pay that month, that's a missed payment. It's something that can be easily fixed. All you have to do is take a look at your credit report every so often. If you see anything that's out of the ordinary, any mistakes on it, contact your bank, contact your financial institute, and make sure they will correct it for you. Another tip is that if you do come to an agreement with your lending institute for a mortgage deferral, make sure you get it in writing, either by email or by mail. They can send you a new agreement by mail. Something that shows that you have an agreement with the bank to defer your mortgage and it's not a missed payment. If you have that, it will be very easy for you to correct any issues on your credit report. So no, it does not affect your credit report. Now, the fourth myth that I often hear is that you're going to have to provide a proof of loss of income. And that is simply not true. Most lenders do not ask for a proof. They simply understand that a lot of people have a difficult situation because they maybe have to take care of someone sick at home. They might not have actually lost their job, but they are unable to go to work to pay their mortgages. So they realize that most lenders don't ask you to prove that you've lost your income. What they may do is to perform a new credit check on you as part of their approval process. The reason being is that maybe when you apply for the mortgage, a few years back your credit was really good, but it has since dropped to a level that they may not want to approve this deferral to you because it acts as like a new loan. You're actually asking them to borrow additional money. If that's the case, you need to figure out what went wrong on your credit report and how to fix that. Once you fix that, most chances are the banks will approve of your mortgage deferral. It could have been a mistake, could have been a payment that you've already made but it wasn't updated on your credit report. Things like that will stay on your credit report, but you need to contact the credit agency to make sure that they correct those so that your scores goes back to normal and you can apply for a mortgage deferral. The last myth that I often hear is that people say mortgage deferral is a scam. It's the banks out to get money. They're not working for the consumer. And that's simply not true. Mortgage deferral is simply a tool to help borrowers. It's no different than other borrowing tools. So let's suppose that you're out of work. You're deciding between paying the bank by mortgages or putting food on the table. This tool, let me show you some benefit. This tool is actually probably the cheapest tools you can use to make ends meet. You could borrow from a line of credit for your everyday needs. Let's suppose that mortgage deferral didn't exist. So now you're going to pay for your mortgages. Now you're going to pay for your everyday expenses. Now you're going to pay for extra expenses. Let's say your kid is going through online school and needs a computer. Things like that. You have someone sick. You need to take care of the medication. So between paying for your mortgage and paying for the necessities, you have the only other ways are that you can borrow from a line of credit, which is probably going to cost you more than your mortgage, because don't forget your mortgage is backed by your house, your home, whether it's condo, it's probably the largest asset that you own. So it's backed by that. So it's probably going to be cheaper than the line of credit. You can go to personal loan, but the rate is going to be 6 to 10% at least. Or you can borrow from credit card. Now, credit card, if you're able to get some introductory rate, maybe it's going to be about 9-10%, but typically they're about 21 to 29%. So that's very expensive. Your last resort might be payday loan. Now, if you've lost your job, obviously that is not even an option. You don't have any pay coming in. But let's say you still have pay coming in, but it's substantially less. Yes, you can go to payday loans, but as of 2018, the Payday Loan Act allows the payday loan company to charge $15 per $100 borrowed every 2 weeks. That works out to about 390% annually. So don't do that. My advice is don't do that. So as you can see, mortgage deferral means you are able to put food on the table versus paying the bank for the short term. Mortgage deferral is also a lot faster to get approval. The bank will simply run a credit check, ask a few questions, and you're instantly approved. To apply for it, there's no need for you to go to the bank. Right now, a lot of branches are instituting social distancing guidelines. Number of employees working there will be less. The wait time is a lot longer. There's no reason for you to go to a physical branch. You can apply for mortgage deferral online or by calling your bank. They usually have a toll-free number that you can call, and you can apply there. It's much easier, and it doesn't affect your credit. It's not anything that will trigger a negative effect on your credit. So if mortgage deferral is something that's suitable for your current situation, you should definitely consider using it. Like I said, many banks are still offering it until the end of June, so you still have time. This wraps up my quick little video on mortgage deferral. Obviously, I am not a mortgage broker. I do not work for the bank. I'm a real estate agent, but I'm trying to provide good information to the public. Hopefully, you found the video useful. If you do have questions, you feel free to reach out to me. My contact information will be at the end of the video, or speak to your mortgage lender, your mortgage broker. They should be able to give you more information pertaining to your particular situation. So thank you for watching. If you like this video, also don't forget to visit my YouTube channel or forward it to your friends and family, whoever you think could benefit from this, and I will see you next time.